One Step Ahead of Wall Street, Peter Lynch with John Rothschild. When I first wrote this book in 1989, I had the average investor in mind. 11 years later, I'm convinced that the principles that helped me achieve good results with the Fidelity Magellan Fund remain just as valid. Markets have changed, prices have risen dramatically, and new trends like internet companies have emerged, but the fundamental logic of investing in good businesses at reasonable prices remains unchanged. From 1982 until the late 1990s, we experienced the greatest bull market in U.S. history. The Dow Jones Industrial Average rose 15-fold. In my jargon, that would be a 15-bagger. Something extraordinary even for a single company, but seeing it across the entire market is truly astonishing. Between 1995 and 1999, we had 5 consecutive years of gains exceeding 20%, something that had never happened before. But bull markets don't last forever, just as bear markets don't either. And the patience that was needed in the difficult markets of the 1970s is just as necessary today to avoid being carried away by the excessive optimism of the bulls. The difference is that back then, one had to remember that bad times pass. Today, one has to remember that good times also pass. The phenomenon of internet companies has generated a euphoria that reminds me dangerously of other fads of the past. Simply adding a .com to a company's name and proposing an exciting idea is enough to convince enthusiastic investors to advance money for an entire decade of growth and prosperity that may never materialize. When a stock's price triples on its first day of trading based on hypothetical future losses rather than actual present profits, something is clearly wrong with the equation. I myself missed out on Amazon. I went to their website in 1997, bought some books for my wife, and recognized that it was an excellent, understandable, and well-positioned business, but I didn't invest. By 1998, the price had increased tenfold. It was a shame. The market, which is the expression I use to refer to all stock market transactions, doesn't wait for a young company to prove its viability over time, like Walmart or Home Depot did. With internet companies, fundamentals have become outdated, but I'm still old-fashioned, and we old-fashioned types believe that sooner or later, profits determine the fate of an investment. Prologue. Let me introduce myself. I'm Peter Lynch, and for 13 years, I managed the Fidelity Magellan Fund, the fastest-growing investment fund in history up to that point. When I started in 1977, the fund had $18 million in assets. When I stopped managing it in 1990, it had $14 billion. During that time, the value of the shares increased 28-fold, meaning that every $10,000 invested initially grew to $280,000. I'm not saying this to brag, but to establish my credentials. I've invested in over 15,000 different companies, visited thousands of corporate headquarters, spoken with hundreds of executives, and learned from success and failure in roughly equal measure. And the most important conclusion I've drawn from all that experience is that the individual investor can outperform Wall Street professionals using the information available to them. This isn't just an encouraging statement to motivate people to invest. It's a realistic observation about how markets work and the limitations of professional managers. Part 1. Preparing to invest. Chapter 1. The Miracle Investor. There's a widespread myth that successful investing requires a special talent, an innate intuition, or privileged access to information unavailable to the average person. This myth primarily benefits those who sell financial services, because if you believe you need professional help to invest, you'll be willing to pay substantial fees for that help. The truth is, there's no innate talent for investing. My own story proves it. There's no ticker tape above my crib. My parents didn't teach me to read stock prices before the alphabet. I grew up in a working-class family. My father died young, and I started working as a caddy at a golf course to help out at home. It was on the course that I first heard club members talking about stocks, companies, and financial markets. I joined Fidelity Investments in 1966 as a summer intern, then did my military service and returned as an analyst in 1969. For years, I dedicated myself to analyzing companies, visiting their facilities, and understanding their business models.
It wasn't talent I had, it was hard work, an insatiable curiosity, and a willingness to do my homework. Individual investors have real advantages over professional investors. The most important is freedom. A fund manager overseeing billions of dollars can't buy shares of a small company without affecting the market price. Even at the size Magellan reached, I was limited to investing in large companies. Individual investors can buy 100 shares of a small, unknown company, and if they're right, they can double or triple their money. Professional fund managers are also subject to institutional pressures that distort their decisions. If they buy a little-known stock and it performs poorly, they have to give uncomfortable explanations. If they buy IBM or Coca-Cola and they perform poorly, they can say it was impossible to foresee. The result is a herd mentality, a tendency to buy the same stocks everyone else is buying, most of which are already well valued. Individual investors don't have this problem. They can buy what they consider good without having to justify themselves to anyone.
Chapter 2. Professionals aren't that smart. There's a category of people I call smart money, which is the popular term for institutional investors, fund managers, Wall Street analysts, and large investment banks. They're supposedly so smart that the small investor doesn't stand a chance against them. The evidence, however, says otherwise. Over 80% of actively managed investment funds fail to outperform their benchmark index over a 10-year period. This means that if, instead of paying management fees, you simply bought a fund that tracks the market index, you would, in most cases, make more money. Management fees, which may seem small as a percentage, add up over the years and become a significant difference. Why do professionals perform so poorly? Not because they're stupid. Wall Street analysts are brilliant and hardworking. The problem is structural. First, large funds can't invest in small companies. Second, managers have incentives to avoid risk. If they follow the herd and everyone else loses, no one blames them. If they stray from the herd and lose on their own, they risk losing their jobs. Third, efficient markets theorize that all available information is already reflected in prices. This is partly true and partly false. There are sectors of the market, especially among small and medium-sized enterprises, SMEs, that are less closely followed by analysts, where the available information is not perfectly reflected in prices. This is where individual investors have their greatest advantage. During my years at the helm of Magellan, I had access to information no individual investor has. I could speak directly with the executives of any company in the world. I had analysts at my disposal and an extraordinary organizational machine. And yet, I made colossal mistakes that any astute investor could have avoided. There were opportunities I missed because I was too focused on the data and not attentive enough to the realities of the business. Chapter 3. Are stocks riskier than bonds? There's a widespread belief that stocks are risky and bonds are safe. This belief is partly correct and mostly wrong. Stocks fluctuate more than bonds in the short term. If you put your money into the stock market today and need it tomorrow, you could lose money. In that sense, stocks are riskier in the short term. But if you have a horizon of 10, 20, or 30 years, the equation changes radically. Since 1927, American stocks have yielded an average of 9.8% annually. Corporate bonds have yielded 5%, government bonds have yielded 4.4%, Treasury bills have yielded 3.4%, and inflation has been 3% annually. This means that Treasury bills, supposedly the safest investment, have had a real return of virtually zero. Stocks, on the other hand, have had a real return of almost 7% annually. Let's put this into perspective with some concrete numbers. If in 1927 you had invested $1,000 in Treasury bills and let them grow for 60 years, reinvesting the interest, you would have ended up with about $7,400. If you had put it into corporate bonds, you would have had around $18,000. If you had invested it in stocks, you would have had approximately $272,000. The risk with bonds that people underestimate is inflation risk. A bond that promises to pay you 4% interest for 20 years seems safe.
But if inflation rises to 6% during those 20 years, you're losing purchasing power every year. Stocks, because they represent ownership of a real business, adjust for inflation naturally. If costs rise, companies raise their prices, and their profits tend to rise as well. There are times when bonds are clearly superior to stocks. In the early 1980s, when interest rates were at 16 or 17%, buying 20-year Treasury bonds was an extraordinary investment that few investors took advantage of. When long-term interest rates are above 6 or 7%, government bonds can be a reasonable alternative to stocks. But under normal conditions of moderate interest rates, stocks are the most profitable long-term investment available. Chapter 4. Pass the mirror test. Before investing a single euro in the stock market, there are some questions you need to ask yourself honestly. Do you own a home? If not, that should be your first financial goal. A home is a form of forced investment that compels you to save, and it generally appreciates at least at the rate of inflation. Furthermore, it provides stability and reduces the risk of becoming homeless in a financial crisis. Do you need the money you're about to invest in the next 5 years? If the answer is yes, don't put it in the stock market. The stock market can fall and stay low for extended periods. If you need that money in 3 years for a down payment on a house or your children's education, a market crash will force you to sell at the worst possible time. Money invested in the stock market should be money you can afford to leave there for at least 5 years, preferably 10 or more. Do you have the personality to weather the downturn? This is perhaps the most important question and the hardest to answer honestly. It's easy to say yes when the market is rising. The real test comes when the market drops 30 or 40%, when newspapers run apocalyptic headlines, when your friends tell you that you've lost everything. At that moment, can you keep a cool head and not sell? Can you even buy more shares taking advantage of the low prices?
Market history clearly shows that investors who sell during panic are the ones who fare the worst. The most brutal declines of the last 100 years, including the 1929 crash and the 1987 crash, were followed by recoveries that took markets to all-time highs. Those who sold at the bottom lost. Those who held on or bought won. Do you have high-interest debt? Credit card debt at 20% interest is the worst investment you can make. Paying it off is equivalent to earning a guaranteed 20% return, something the stock market rarely surpasses. Before investing in stocks, pay off expensive debt. Chapter 5. What type of investor are you? There are several ways to participate in the financial markets, and the right one depends on your personal situation, your temperament, and the time you can dedicate to research. The simplest option is to invest in low-cost index funds. These funds replicate the performance of a market index, such as the S&P 500 in the United States or the IBEX 35 in Spain, by buying all the stocks in the index in the same proportion. Fees are minimal because there's no manager making active decisions, and long-term returns outperform most actively managed funds. If you don't have the time or inclination to analyze individual companies, this is the best option. The second option is to invest in well-selected, actively managed funds. The key here is to choose funds with a consistent long-term track record, reasonable fees, and a manager who has a clear strategy and sticks to it. Be wary of funds that change their style based on current trends. The third option, and the most exciting, but also the most demanding, is to invest directly in individual stocks. This is the option this book primarily addresses. To do it well, you need to dedicate time to research, keep track of your investments, and have the discipline to buy and sell based on rational criteria, not on fear or fleeting euphoria. Part 2. In Search of the Winners. Chapter 6. Dragging Through Wall Street. At Fidelity, my typical day started at 6:30 a.m. and ended after 7 p.m. I attended between 10 and 15 meetings with company executives every day. I read hundreds of annual reports a year. I traveled constantly. My secretary received 600 calls a day. At Magellan's peak, I held positions in more than 1,400 companies simultaneously. This isn't meant to boast, but rather to highlight the contrast.
The average investor doesn't need to and can't do all this. They don't need to track 1,400 companies. By closely monitoring 5 or 10 companies they know well, they can achieve excellent returns. The key is to focus on what you know. At your job, in your city, in your daily life, you're exposed to products, services, and companies about which you have first-hand information that no analyst in New York possesses. That information has a value that most individual investors overlook. Chapter 7. Wall Street doesn't know what it's losing. The best place to find great investment opportunities isn't in Wall Street offices, but in everyday life. Here are some examples of how this process works in practice. Legs hosiery. In the mid-70s, my wife Carolyn would come home from the supermarket frustrated because they were always sold out. Legs hosiery, packaged in that egg-shaped container, had become a consumer phenomenon. That simple fact, the difficulty in finding the product in stores, was a sign of demand exceeding supply. I did some further research, confirmed that the company's numbers were solid, and bought shares of Hanes Corporation. It was an excellent investment. Dunkin' Donuts. I was a regular customer. Every morning I bought my coffee and a donut. I noticed that the quality was consistent, the price reasonable, the service fast, and there were always customers. I started asking friends and colleagues about their experiences. The response was universally positive. I looked into the numbers, confirmed that the franchise model was solid and that they had enormous expansion potential. I bought shares. The price multiplied several times. Taco Bell. During a trip to California, I discovered this Mexican fast food chain that didn't exist on the East Coast. The concept was clear, the prices affordable, the food good, and the place was always packed. I did some research, found out the company had plans for national expansion, and I bought a share. Years later, Taco Bell was bought by PepsiCo for a price that multiplied my investment. The Point Company. During a business trip, I stayed at one of their hotels and was impressed with the quality at a competitive price. The hotel manager enthusiastically explained their expansion plans. I called the head office, requested the annual reports, analyzed the figures, and bought a hotel. It was one of my best investments. The pattern is always the same. Observe something in the real world that seems unusually good, turn that observation into the beginning of an investigation, confirm with numbers that the company is well managed and has growth potential, and then invest.
Chapter 8. The Ideal Investment Tour. An ideal day of investment research could be as simple as a stroll through a shopping mall. You observe which stores are bustling with customers, which ones seem empty. You ask your children what clothing brands are popular with their generation, what restaurants they visit with their friends, what technology they use. These conversations can be the starting point for researching companies that will become great investments. My daughter Mary was the one who alerted me to The Limited, the women's fashion chain that turned out to be an extraordinary investment. My wife Carolyn pointed out several consumer trends that translated into winning stocks. My colleagues at Fidelity, in sectors as mundane as tracking pharmaceutical or industrial companies, identified trends in their own industries before the broader market. The advantage of the industry expert. If you work in a hospital, you know which medical equipment is most useful, which pharmaceutical companies have the most effective products, and which technologies are changing medical practice. That knowledge, before it reaches the general investing public, is a real competitive advantage. If you work at a technology company, you know which software or hardware vendors have the best products before Wall Street analysts discover them. If you work in retail, you know which suppliers deliver on time and with good quality, and which logistics companies are efficient. If you're a doctor or pharmacist, you know which medications are being enthusiastically prescribed before they even appear in official statistics. This isn't insider information in the legal sense. It's the natural advantage you have from being in the right place and paying attention to what's happening around you. Chapter 9. Reviewing the curriculum. Before buying shares of a company, you need to develop what I call the stock story. I don't mean a sophisticated 100-page analysis, but rather a clear and simple narrative that explains why this company will be worth more in the future. A good story has to answer several basic questions. What is the company's core business? What differentiates it from its competitors? Is it growing, and why? Can it sustain that growth?
Are the business numbers good? If you can't answer these questions in 2 or 3 sentences, you probably don't understand the company well enough to invest in it. Buying shares of a company without understanding its business is like gambling in a casino. Sometimes you'll win, but you won't have any rational basis for distinguishing the good ones from the bad. Some stories are simple and clear. This fast food company has 50 very successful restaurants in the Northeast and is going to expand to the rest of the country in the next 5 years. Or, this software company has the best product in its category, just closed a contract with the federal government, and its sales are going to triple. Other stories are more complex and require more research. But complexity is not a virtue in investing. Some of my best investments were the simplest to explain. Chapter 10. The benefits, the benefits, the benefits. The price of a stock and the company's profits are inextricably linked in the long run. In the short term, the price can diverge from profits in either direction, but over several years, the price always ends up reflecting the reality of the profits. If profits grow, the price rises. If profits fall or disappear, the price falls. This is why the price-to-earnings ratio, or PE ratio, is the most useful indicator for individual investors. The PE ratio tells you how much you're paying for each euro of a company's earnings. If a company earns €1 per share and the share price is €15, the PE ratio is 15. If the share price is €30, the PE ratio is 30. A high PE ratio can be justified if earnings are expected to grow rapidly. A low PE ratio can be a trap if earnings are about to decline. The key is to compare the PE ratio with the expected earnings growth rate. There's a rule of thumb I've developed over the years. A company whose PE ratio roughly equals its annual growth rate is reasonably valued. If the PE ratio is half the growth rate, the stock is cheap. If the PE ratio is double the growth rate, the stock is expensive. For example, if a company grows at 20% annually and trades at a PE ratio of 20, that's a reasonable ratio. If the same company trades at a PE ratio of 10, it's probably cheap. If it trades at a PE ratio of 40, it's generally expensive. This rule has exceptions and is not a substitute for a full analysis, but it is a useful tool for making a quick first screening of potential opportunities. The overall market's PE ratio also matters. A market where companies average a PE ratio of 20 is an expensive market. One where the average PE ratio is 10 is a cheap market. During the bubble of the 1960s and 70s, many companies traded at PE ratios of 40, 50, or higher, with growth that didn't justify those prices. The inevitable correction was brutal. At the best times to buy stocks, markets trade at low PE ratios, and investors are depressed and pessimistic.
Chapter 11. The 2 minutes of silence. One practical technique I use to evaluate investments is what I call the 2-minute exercise. Before buying a stock, I sit down quietly and try to explain in 2 minutes, as if I were explaining it to a 15-year-old, why that stock is a good investment. If I can't do it in 2 minutes, the story is probably too complex or I don't understand it well. The best investments often have simple stories. This company is in a sector that's going to grow a lot and is well positioned to capture that growth. Or, this company is very undervalued relative to its real assets. Or, this company is overcoming its problems and returning to profitability. This exercise also forces you to identify the main driver of your investment. Are you betting on business growth, on asset appreciation, on a recovery in profits? Knowing exactly why you buy helps you know when to sell, when the original reason is no longer valid. Chapter 12. The actions I like. There are certain types of situations that have proven more profitable for me over the years. The first is the boring company in a boring industry. Nobody wants to talk about a company that makes bottle caps, or provides building maintenance services, or manages industrial waste. That lack of glamour keeps analysts and institutional investors away, which often means the shares trade at reasonable prices. If the business is good, the returns can be extraordinary. I myself owned shares in several companies whose business was so prosaic that I found it difficult to explain what it entailed, but which generated splendid returns.
The second favorable situation is a company with a ridiculous or unattractive name. Bob Evans Farms was one of my investments. Shoe Carnival, Ugly Duckling, names that don't inspire confidence, but a ridiculous name repels investors looking for image and glamour, and that can create opportunities. The third category consists of companies that do depressing things. Funeral service companies, waste management companies, pest control companies, businesses no one wants in their portfolio because it's not polite to mention them at dinner parties. But these businesses are often very profitable, with high barriers to entry and inelastic demand. The fourth is the company that operates in a specialized niche with no clear competition. If a company is the only one doing something in a particular region, or holds a patent granting it exclusivity on a key product, or has built such a loyal customer base that switching suppliers would be prohibitively expensive for them, that business can be extraordinarily profitable for many years. The fifth group consists of companies that institutional investors cannot or will not buy. A $500 million fund cannot invest in a company with a $10 million market capitalization. If it were to buy 1% of the company, it could barely invest $100,000, an insignificant amount relative to its overall figures. This exclusion of the major players means that many excellent small companies are systematically undervalued. The sixth sign is companies where insiders, the executives and board members themselves, are buying shares. When the people who know the most about the true state of a business use their own money to buy shares in that business, it's a very positive sign. Chapter 13. The numbers that really count. To analyze a company, you don't need to be an accountant or know all the details of financial analysis. There are a limited number of figures that will give you most of the information you need. Percentage of sales. If a company has grown primarily thanks to a flagship product, you need to know what percentage that product's sales represent of the company's total sales. If that percentage is small, the product's success will have little impact on overall results. I recall the case of Johnson & Johnson's Retin-A cream in 1988. The media reported that it could eliminate wrinkles, and the stock price skyrocketed. But anyone who had done their homework would have discovered that Retin-A sales represented barely 2% of Johnson & Johnson's total revenue. The stock's movement was completely disproportionate and created an opportunity for investors who sold. The P/E ratio compared to growth. I mentioned this before, but it's worth repeating. Look for companies where the P/E ratio is equal to or lower than the annual earnings growth rate. If you find a company with a P/E of 15 and 25% growth, it's worth investigating further. Cash position. Look at how much cash the company has minus its total debt. If a company is trading at $10 per share but has $5 per share in net cash, you're actually buying the business for only $5. If the business is reasonably good, it's hard to lose money at that price. The debt-to-equity ratio. A company with a high debt relative to its equity has a high financial risk, especially during times of crisis. I prefer companies with little debt, or better yet, with more cash than debt. If the business takes a turn for the worst, a debt-free company can weather the storm for a long time. A highly indebted company can go bankrupt. Free cash flow per share is the actual cash a business generates after paying all its necessary expenses and investments. A company may have healthy accounting profits, but generate little cash if it needs to constantly invest in equipment or inventory. Free cash flow is more difficult to manipulate in accounting than profits.
Inventory trends. If inventory grows faster than sales, it's a red flag. It could indicate that products aren't selling as well as expected, that the company is overproducing, or that it's shifting its strategy toward a higher production rate. Any of these situations warrants further investigation. Net profit margin. By comparing a company's margin with that of its competitors in the same sector, you can see if it has real competitive advantages. A company with consistently higher margins than the industry average usually has some advantage that is difficult to replicate. Chapter 14. Recapping. Once you've identified a promising company, developed its story, and analyzed the key numbers, it's time to make the final pre-buy checklist. What is the market capitalization? Company size matters.
A large company can rarely increase its value tenfold. A small company can. Adjust your expectations based on size. What is the P/E ratio, and how does it compare to expected growth, to competitors in the sector, to the company's own historical P/E ratio? How much debt does it have? Does it have more cash than debt? Are insiders buying or selling? If executives are buying shares with their own money, it's a positive sign. If they're selling en masse, it's worth asking why. How many institutional investors already own this stock? If 80% is already held by funds, there's little room for new buyers. If there are hardly any institutional investors, there's potential for them to enter the market and drive the price up. Has the company's financial situation improved or worsened in the last year? Is the profit margin rising or falling? Is the company generating more or less cash? Chapter 15. The final numbers. There are a number of warning signs that tell me I should steer clear of a potential investment. When a company in a slow-growth sector trades at a very high P/E ratio, the situation is dangerous. It reminds me of Avon in the 1970s, which traded at a P/E ratio of 64. To justify that price, the company would have had to increase its sales to exceed the market capitalization of several of the largest industries in the United States. That was impossible. When a company constantly issues many new shares, it's a sign that it needs external capital to operate, which dilutes existing shareholders and may indicate cash flow problems. When a company name includes words like technological, advanced, futuristic, or similar terms without any concrete business behind it, I'm suspicious. Grandiose names often mask mediocre businesses. When a company has just diversified into a business completely unrelated to its core activity, it's a sign that management has more ambition than good judgment. Absurd diversifications, which I call diversification, destroy value with alarming frequency. When a company's main client accounts for more than 50% of its sales, the dependency is dangerous. If that client switches suppliers or experiences difficulties, the impact can be devastating. Part 3. The Long-Term Vision. Chapter 16. Designing a Portfolio. There is no single perfect portfolio that works for everyone. The right portfolio depends on your financial situation, your investment horizon, your risk tolerance, and the time you can dedicate to monitoring your investments. That said, there are some general principles that have guided me. The first point is that diversification has its limits. Holding 50 stocks in your portfolio without truly understanding any of them is less secure than holding 8 or 10 that you know inside and out. Excessive diversification doesn't eliminate risk, it simply averages it out. And if you've done your homework, your average should be better than the market average. The second point is that the stock category determines how many you need in each segment. For low growth or stable companies, a few well-chosen stocks are sufficient. In high-growth companies, it's advisable to have more because the individual risk is greater. Some will fail, but those that succeed will more than compensate. The third point is that you should review your portfolio periodically, but not obsessively. Once every 6 months is sufficient for most investors. During each review, check if the original performance history of each investment still holds true. Have the expected growth materialized? Is the anticipated recovery underway? Are the hidden assets you identified being recognized by the market?
The fourth is that you must be willing to admit mistakes and correct them. If you bought a company for the wrong reasons, or if the situation has fundamentally changed, sell, even if you're losing money. Holding on to a loss, hoping to recoup it, is one of the most costly mistakes investors make. Chapter 17. The best time to buy and sell. Regarding market timing, it doesn't exist. In my more than 30 years in the financial markets, no one has been able to consistently predict whether the market will go up or down in the next 6 months. Those who claim otherwise on television are wrong about half the time, which is exactly the same as flipping a coin. What you can do is buy good companies when they're reasonably priced and be patient.
The best protection against market uncertainty isn't trying to predict its movements, but buying such good companies at such reasonable prices that they can withstand even a bad market. There are situations that make buying more attractive. When the market has fallen significantly without fundamentally good companies changing, it can be a good opportunity. When a sector is experiencing temporary difficulties and the shares of good companies in that sector have fallen rationally along with the bad ones, there are opportunities. When a specific company has a temporary problem that the market is interpreting as permanent, it may be the time to buy. Regarding when to sell, the most common reason to sell shouldn't be that the price has gone up. If the company is still good and the price remains reasonable relative to its prospects, there's no reason to sell. I've held winning stocks for years and decades because the story remained positive. The principle of selling winning stocks too soon, what Wall Street calls cutting the flowers and watering the weeds, is one of the most costly mistakes. Valid reasons to sell include that the original story has ended, the P/E ratio has risen to levels not justified by expected growth, signs of deterioration in the business, massive selling by insiders, or you have found a clearly better investment to replace it. Chapter 18: The 12 Stupidest Fools About the Market. Over the years, I have compiled a list of phrases that are said about the market that are at best useless and at worst dangerous. If it's already gone down that much, it can't go any lower. Stocks don't have a memory. A stock that has fallen from 20 to 10 can continue to fall to 5 or to 0. Past price does not determine future price. You can always tell when the market is bottomed out. Nobody can. Market bottoms are only recognized in hindsight. If you wait until you're sure the market is bottomed out to buy, you'll always buy after the bounce. These stocks have dropped so much that I won't sell them until they return to the price I bought them for. This strategy allows mediocre or bad companies to occupy space indefinitely in your portfolio. If the fundamentals don't justify the price you paid, there's no reason to expect them to recover. It's only $1 per share, what can I lose? You can lose that $1 per share, which is exactly 100% of your investment. A stock worth $1 can be worth 0 just as easily as one worth 100. Sooner or later, they'll go up. The history of the market is full of companies that never recovered. Kodak, Sears, many companies that seemed eternal ended up in irrelevance or bankruptcy. Chapter 19: Options, Futures, and Derivatives. The world of financial derivatives is fascinating from an intellectual point of view and highly dangerous from a practical point of view for the individual investor. A call option gives you the right, but not the obligation, to buy a stock at a predetermined price before a predetermined date. A put option gives you the right to sell. Futures are contracts to buy or sell an asset in the future at a price agreed upon today. More sophisticated derivatives combine these features in increasingly complex ways. The fundamental problem with these instruments for the individual investor is that you not only need to predict the direction of the price movement, but also the exact moment that movement will occur. You can be completely correct that a stock will rise and still lose all your money with a call option if the price doesn't rise before the expiration date. I've seen very intelligent and experienced people lose fortunes with options. The combination of leverage and time limits is lethal for most investors. My advice is to stay completely away from these instruments unless you're a professional with specific expertise and access to sophisticated risk management tools. Chapter 20: A few final words on financial markets. After 30-plus years in the financial markets, I've come to several conclusions that I feel are important to share. Markets are more efficient than those who despise them believe, and less efficient than those who venerate them. In the segment of large companies closely followed by analysts, it is very difficult to find information that the market has not already processed. In the segment of small and medium-sized enterprises, less closely followed, inefficiencies are frequent and exploitable. America, and the developed world as a whole, remains an extraordinary environment for business. Companies have demonstrated an admirable ability to adapt to change, overcome crises, innovate, and create value. Capitalism has many flaws, but its capacity to create wealth over the long term is unparalleled in history. Betting on the American economy for the long haul has historically been one of the most profitable bets one can make. Bear markets are painful but inevitable. In my years as a fund manager, I've weathered several major bear markets. Each one seemed, while it lasted, potentially catastrophic. None of them were. All were followed by bull markets that drove prices to new all-time highs. The lesson is that temporary pessimism creates permanent opportunities for the patient investor. The investor's greatest enemy is himself, not the markets, not professional managers, not Wall Street. Impatience, fear, greed, following trends, the inability to tolerate volatility, these are the factors that destroy more value than any market crash. Conclusion: 20 golden rules for the individual investor. Throughout this book, I've outlined the principles that guide my investment approach. Let me summarize them as concrete, actionable rules. First, research before investing. No investment decision should be made without spending at least 1 to 2 hours reading about the company, understanding its business model, and reviewing the most important numbers. Second, invest in what you know. Your first-hand knowledge of industries, products, and companies is a real competitive advantage. Use it. Third, ignore the short-term market. The daily noise of prices says nothing about the long-term value of a good business. Learn to separate price from value. Fourth, the P/E ratio matters. Buy companies at reasonable prices relative to their earnings and growth prospects. Avoid glamorous stocks with outrageous P/E ratios. Fifth, debt matters. Prefer companies with little debt or with more cash than debt. Excessive debt turns temporary problems into permanent crises. Sixth, understand what type of company you have. Expectations should be consistent with the category. Don't expect a 10-star bagger from a low-growth company. Eighth, look for lasting competitive advantages. A company that has something its competitors cannot easily replicate, whether it's a brand, a patent, a prime location, or a loyal customer base, can generate extraordinary profits for many years. Ninth, insiders buying is a good sign. Nobody knows the true state of a business better than those who run it. If they're buying shares with their own money, it's a vote of confidence worth considering. 10th, boring companies in boring sectors often offer the best opportunities. The lack of glamour keeps institutional investors away and can create very attractive valuations. 11th, portfolio rotation has a cost. Every time you buy and sell, you pay fees and taxes. Maintaining good investments over years reduces these costs and allows compound interest to work in your favor. 12th, diversify reasonably, but not excessively. Between 5 and 15 well-known companies is a manageable portfolio. More than 20 without active monitoring is an expensive fund portfolio. 13th, don't try to anticipate the market. Nobody can do that consistently. Instead, invest regularly and be patient. 14th, bear markets are opportunities in disguise. The best investments are made when pessimism is at peak and prices are their lowest. 15th, review your investments periodically. Ask yourself if the original story still holds true. If it doesn't, sell. If it does and the price is dropped, consider buying more.
16th, admit your mistakes quickly. Pride is a costly investment. If you made a mistake, acknowledge it, sell if necessary, and learn from the experience. 17th, ignore macroeconomic predictions. The world's brightest economists have consistently failed to predict recessions, expansions, and interest rate cycles. Don't base your investment decisions on macroeconomic forecasts. 18th, read the annual reports of the companies you invest in. The chairman's letter, the balance sheet, and the income statement contain more useful information than any external analysis. 19th, the stock market rewards investment in good companies in the long run. This historical fact, consistent over decades and in multiple countries, is the basis of all the logic of stock investing. 20th, be patient.
The best investments don't pay off in weeks, but in years. Patience is the most profitable virtue of all. Investors who have read this far and wondered if all this is too simple to be true have a good intuition. It's not that it's simple, it's that the basic principles are accessible to anyone willing to learn and put them into practice. Success in investing doesn't require a mathematical genius or a PhD in finance. It requires common sense, intellectual curiosity, emotional discipline, and a willingness to do your homework. Mr. Market, that character from Benjamin Graham's allegory, is a bipolar man who offers you the chance to buy or sell every day at prices that are sometimes very high and sometimes very low. Your job is not to follow his instructions, but to take advantage of his excesses. When he's euphoric and offers ridiculously high prices, sell. When he's depressed and offers ridiculously low prices, buy. And when prices are reasonable, simply stay put and let the market work for you. This is, in essence, the philosophy of investing one step ahead of Wall Street. Further expansion. Key concepts in detailed examples. The characteristics of the perfect action. Throughout my years of investing, I've identified a number of characteristics that make a company particularly attractive. A company doesn't need to possess all of them to be a good investment, but the more it has, the better. The first and most important requirement is that the business be boring, or better yet, ridiculous. The perfect stock should be associated with a perfectly boring company in a perfectly simple business. The more boring, the better. Automatic data processing is a good name, but not as boring as Bob Evans Farms, and neither can compete with Pep Boys Manny Moe and Jack. Who would want to own a company that sounds like the Three Stooges? No one looking for a certain image, but precisely because of this, the company's price could rise without anyone on Wall Street noticing until it was too late. The astute investor had plenty of time to accumulate shares at reasonable prices before institutional managers discovered the business. The second characteristic is that the company does something unpleasant. Crown Cork and Seal makes cans and bottle stoppers. Safety Clean goes around auto repair shops collecting dirty oil and grease residue. Envirodyne Industries, which produced hot dog wrappers and plastic forks, wasn't exactly glamorous either. These companies attract so little attention from analysts that their stocks can be undervalued for years while their profits quietly grow. Waste Management is perhaps the extreme example. It's a company that manages toxic waste. Furthermore, rumors circulated that the mafia was involved in the waste management business. Respectable investors wouldn't even look at it. The result was that its stock increased in value 100-fold, while respectable investors looked the other way. The fourth characteristic is that the company is a spin-off. When a large company separates one of its divisions and makes it an independent entity, the result is often extraordinarily profitable. Parent companies are reluctant to spin off divisions that might later run into trouble because that would generate bad publicity. Therefore, the spun-off entities generally enter the market with strong balance sheets and are well positioned for success. Toys R Us was spun off from Interstate Department Stores in 1978. The parent company's creditors received stock in the new Toys R Us as part of the bankruptcy proceedings. Those who recognized the value of the business reaped a profit of 57 times their investment. The separation of AT&T into the 7 Baby Bells in 1984 was the largest spin-off in history up to that time. The new regional companies, freeing from the parent company's bureaucracy, focused on increasing revenue, cutting costs, and improving profits. Average earnings over the next 5 years exceeded 170% when dividends are included, doubling the overall market return. The fourth characteristic is that institutions barely hold these shares and analysts don't follow them. If you find a company that no analyst has heard of, you found a potentially extraordinary opportunity. Institutional investors can't buy shares of small companies because they would drive the price with their own buy orders, and if no analysts are following the company, valuation inefficiencies can persist for years. When I'm told at a company's office that the last analyst visited was 3 years ago, I can hardly contain my excitement.
The fifth characteristic is that the company operates in a niche market. If the company is the only one doing a certain thing in a certain geographic area,
or holds a patent that grants it exclusivity, or has built such deep customer loyalty that switching suppliers would be very costly, that business can be extraordinarily profitable for many years without needing to grow much. The sixth point is that insiders are buying shares. Nobody knows the true state of a business better than its executives and board members. When they use their own money to buy shares, they're essentially voting with their personal portfolios. It's not a guarantee of success, but it's a very positive sign that I always take into account. The most common mistakes I made. I confess that I've made so many mistakes throughout my career that I could fill a book with them, but some of them are repeated often enough to warrant special attention. The first and most costly mistake is selling winning stocks too soon. I sold Warner Communications at $38 because I thought it was too widespread. The company continued to climb to over $180. I sold Toys R Us at $5, a profit of 5 times my investment, because I thought the entry of a large investor had artificially inflated the price. The price reached $25. With Flowers, a bakery company, and Lance, a cookie company, I also exited too soon, expecting a takeover, which did come, but long after I had sold. The principle I've learned the hard way is this: when you have a great company at a good price and all the indicators point to it remaining a great company for many years, hold on. Don't be swayed by market noise, your broker's advice, or the fear that it's already gone up too much. The probability that a stock that has multiplied 5-fold will continue to multiply depends on the company's fundamentals, not how much it has already risen. The second mistake is the opposite: holding on to losing stocks for too long, hoping to recoup your purchase price. Stocks don't know what you paid for them. If you buy at $20 and it falls to $10, a recovery price of $20 has no economic significance. The only relevant question is whether the stock at $10 is cheap or expensive relative to the current and expected fundamentals of the business. The third is ignoring signs of deterioration because I don't want to admit I was wrong. On several occasions, I held on to positions in companies whose history had fundamentally changed because I found it difficult to admit my mistake. Each time I did, the cost was greater than if I had sold as soon as the fundamentals changed. The fourth is letting external noise distract me from the fundamentals. There were periods when macroeconomic theories about the money supply, budget deficits, interest rates, or currency movements dominated market discussions, and every time I let myself be swayed by that kind of reasoning, I made worse decisions than when I focused on the individual businesses I knew well. The importance of monitoring. Buying stocks is only the first part of the job. Keeping track is just as important. Whenever there's significant news about a company I own stock in, or at least once every 6 months, I ask myself the same questions I asked myself before I bought. Does the original story still hold true? Is the expected growth materializing? Have competitors emerged that threaten the business model? Has anything fundamental changed in the sector? Are the numbers still good? Is profit still growing at the expected rate? Is the balance sheet still strong? Is the company generating the cash it should? Is the price still reasonable? If the story is good, but the price has gone up a lot, is there still room to make a profit? If the story is good and the price has dropped, is it a bargain I should take advantage of by buying more? There are several warning signs that lead me to reduce or eliminate a position. If the P/E ratio has risen to a level that isn't justified by expected growth, it's usually time to sell. If the company starts diversifying into businesses it doesn't understand or that aren't related to its core business, I get worried. If executives who were buying shares 6 months ago are now selling, I start to wonder. If profit margins are falling without a convincing temporary explanation, that's a serious sign. On the other hand, if the story remains positive but the price has fallen for no fundamental reason, it's often an opportunity to buy more. Some of my best decisions with Magellan were to buy more shares of excellent companies when the market was punishing them unfairly in the context of a general correction. Recoverable companies deserve special treatment because they are both the most exciting and the most dangerous investor in the investment universe. A recoverable company is one that has had serious problems, whether due to management errors, adverse changes in its sector, accidents or catastrophes, or a combination of all these factors, and is in the process of overcoming those problems. Chrysler in the 1980s is the classic example. The company had accumulated enormous losses, its models were uncompetitive, and it was on the verge of bankruptcy. The federal government had to guarantee a loan that saved the company. With Lee Iacocca at the helm, Chrysler redesigned its product lineup, drastically cut costs, and returned to profitability. The stock, which had fallen to $3, eventually traded over $40. General Public Utilities, owner of the 3 Mile Island nuclear power plant, was another interesting case. After the 1979 accident, the stock price plummeted from $10 to $3. The situation seemed catastrophic, but anyone who calmly analyzed the situation would realize that the other reactor of the plant had not been affected and could be brought online. In 1985, when GPU announced that the second reactor would be restarted and that other electric utilities would share the costs of decontaminating the first reactor, the stock price began to recover. Those who bought shares at $15 in 1985 sold them for $38 in 1988. To invest in recoverable companies, the most important questions are: can the company survive the onslaught from its creditors? How much cash does it have? How much debt? How long can it operate at a loss before running out of liquidity? Has it identified and is it addressing the problems that caused the crisis? Is it divesting unprofitable divisions that were draining resources? In 1983, Texas Instruments announced it was abandoning the home computer business, where it had lost over $500 million in a single year. This ill-advised decision resulted in enormous short-term losses, but it freed the company to focus on its true strengths, semiconductors and defense electronics. The stock price rose from $101 to $176 in the months following the announcement.
Hidden asset companies. Hidden asset companies are my favorite category because they represent the ideal of smart investing, buying a lot for little money. Pebble Beach Company is the example I most regret not having taken advantage of. At the end of 1976, the stock was trading at $14.50, valuing the company at a mere $25 million. 3 years later, 20th Century Fox bought the company for $72 million. And then, something fascinating happened. Fox immediately sold the Pebble Beach Stone Quarry, just one of its many assets, for $30 million. In other words, the quarry alone was worth more than the total price investors could have paid for the entire company in 1976. The land, the Del Monte Forest, the hotels, and the golf courses were all included for free. Harwind and Wolff was another similar case. It was a publicly traded company with two extraordinary properties, Rancho Kauai in California and Rancho Newhall, a vast tract of land north of Los Angeles with a planned community, an amusement park, a large office complex, and a shopping mall under construction. Homeowners around Rancho Newhall could see their land prices rise year after year. Anyone who had bothered to investigate would have discovered that the company's stock was selling for a fraction of the value of their land. The stock price increased 20-fold since the early 1970s. Penn Central, after emerging from bankruptcy, may have been the largest hidden asset company in history. It had massive tax credits, meaning that when it started making money again, it wouldn't have to pay any taxes. It owned large real estate holdings in Florida and other states. It owned coal mines in West Virginia. It owned airline rights in Manhattan. And it had all of this at a time when nobody wanted to hear its name because it had been through bankruptcy. The stock price increased 8-fold. Liberty Corp is a company I'm still invested in. It's an insurance company that also has holdings in the television industry. When I discovered that those television holdings were worth approximately $30 a share and that the stock was trading at $30, the calculation was simple. I was buying a perfectly reasonable insurance business for $0 because the value of the televisions alone paid for the entire company. Alico was a small cattle company in Florida, headquartered in the tiny town of LaBelle at the edge of the Everglades.
When I visited, all I saw were pine trees, brush, dwarf palms, and a few grazing cows. It didn't seem like much, until you realized you could buy a share for less than $20, and 10 years later, the land alone was worth more than $200 per share. Hidden assets can take many forms. They can be real estate valued at historical cost when the market has risen sharply. They can be unlisted subsidiaries worth more than the listed company. They can be undervalued patents or trademarks. They can be accumulated tax credits that will reduce future taxes. They can even be accumulated losses, as in the case of Penn Central, that create a valuable tax shield. The key to identifying these situations is to pay attention to your work or living environment. Employees of a railroad company might know that their company owned vast tracts of land inherited from the 19th century when the government gave away half the country to encourage the construction of railway lines. Employees of a cable company might know that each cable subscriber was worth several hundred or even thousands of dollars to any potential buyer and compare that value to the company's stock price. The psychology of a successful investor. After everything I've said about company analysis, financial ratios, and investment categories, I want to end with what I believe is the most decisive factor in the success or failure of any investor: their psychology. Markets are brutally good at identifying and exploiting investors' emotional weaknesses. When the market falls, the visceral feeling that things are going to get worse is so intense that it's hard to resist selling. When the market rises, the feeling that you're missing out is equally intense, leading many investors to buy expensive stocks in trendy sectors without understanding the business. The most successful investors are those who have developed a strong conviction in their analysis and maintain that conviction in the face of market pressures. It's not stubbornness. If the fundamentals change, they have to change their minds. But if the fundamentals haven't changed and the price has, they have the discipline to hold or even increase their position. I've known individual investors who had brilliant analyses of excellent companies, but who sold at the first sign of panic and missed out on extraordinary gains. I've also known very intelligent professional managers who never were able to translate their intelligence into superior returns because their emotions interfered with their decisions. The recipe for emotional discipline isn't easy to give, but some things help. First, understand why you bought each stock. If you have a clear understanding of each investment's history, in moments of panic, you can ask yourself if that history has changed, and if it hasn't, resist the temptation to sell. Second, have a long investment horizon. If you know you won't need that money in the next 10 years, a short-term 30% drop loses much of its power to terrify you. Third, diversify reasonably. If you have too much in a single position, any adverse movement generates a level of anxiety that makes it very difficult to make rational decisions. Fourth, and perhaps most importantly, tune out the noise. Financial TV channels, market commentators, apocalyptic headlines, all of that is designed to generate excitement, not to help you make better investment decisions. The less noise you consume, the clearer your decisions will be.
The health of Wall Street and the American stock market. In my years in the markets, I've seen how the American stock market has become the most powerful engine of wealth creation the world has ever known. Companies like Walmart, Home Depot, McDonald's, Microsoft, and hundreds of others have created tens of billions of dollars of value for their shareholders, and that value has been distributed in varying proportions among the millions of people who had the vision and patience to invest in them. But I've also seen the excesses, the conglomerate bubble of the 1960s, when companies bought other companies in any sector without any operational logic, and the market rewarded them for it until it rewarded them with disaster. The growth stock bubble of the 1970s, when perfectly good but by no means extraordinary companies traded at PE ratios of 50 and 60 times. And more recently, the dot-com bubble, where companies with no profits, and in many cases no significant revenue, traded at valuations that would have required them to conquer entire markets over decades. Each of these excesses ended badly, and in each case, the warning signs were there for anyone who cared to see them. Historically unusual PE ratios, a disconnect between prices and fundamentals, and widespread euphoria that made any skepticism seem ridiculous. The prudent investor doesn't need to predict when the party will end, but they do need to be aware that parties do end, that unprofitable companies can't maintain their valuations indefinitely, and that at some point the market returns to its fundamentals. America remains an extraordinary place to do business and to invest in it. The adaptability of American companies, the depth of their capital markets, the strength of their institutions, and the creativity of their entrepreneurial class are unparalleled in the world. This doesn't mean that every company is a good investment or that the market will never crash. It means that in the long run, history has shown us that those who invest patiently in good American companies will ultimately be rewarded. The individual investor who has read this book now has the conceptual tools to identify opportunities, analyze them rigorously, and maintain their positions with the necessary conviction. What they do with those tools is up to them. The art of building and managing a portfolio. The ideal portfolio isn't the one with the best performance in any given month, but rather the one that generates the best results over several years with a manageable level of risk. Building it requires a balance between different categories and sectors, flexibility to add or reduce positions as circumstances change, and the discipline to resist market trends. My personal approach has always been to maintain a mix of companies from different categories. Stable companies provide a defensive base that withstands bear markets reasonably well. High-growth companies are the ones that generate the big returns over 3 to 10-year periods. Cyclical companies, well chosen at the right point in the cycle, can add extraordinary returns. And some turnaround or hidden asset companies complete the mix. I don't recommend dividing your portfolio equally among these categories. The right proportion depends on the market phase, available opportunities, and each investor's personal circumstances. What I do recommend is always having at least 1 or 2 high-growth companies in your portfolio, because they contribute the most to long-term performance. Regarding the size of individual positions, I would never concentrate more than 10 or 15% of my portfolio in a single company, no matter how convinced I am of its prospects. Negative surprises happen even with the best companies, and excessive concentration means that a single mistake can have devastating consequences. On the other hand, it also makes no sense to hold positions so small that even if you're right, the impact on the portfolio is negligible. If a company represents 2% of the portfolio and your stake increases tenfold, you'll have gained 20% on that position. If it represents 10%, the same trade will yield 100% of the portfolio's value. One tactic I've found useful is to start with small positions in promising companies and increase them as the fundamentals confirm the initial story. If I buy for the first time and subsequent quarterly results confirm the expected growth, I add more. If the results disappoint, I investigate whether it's a temporary or structural problem before deciding whether to hold, add, or sell. I also recommend keeping a record of the reasons you bought each stock and reviewing that record periodically. Not because you're going to follow it mechanically, but because it helps you maintain clarity about what led you to invest and what signs would indicate you were wrong. Without that record, it's easy to convince yourself that the reasons for holding a position are the same as they were at the beginning, when in reality, the situation is changed. Brokers, reports, and other sources of information. A broker can be a valuable ally or an expensive distraction, depending on how you use them. Good brokers execute your orders efficiently and can provide access to information that would otherwise be difficult to obtain. Bad brokers call you periodically to convince you to make trades that generate commissions for them, but not necessarily value for you. The golden rule with brokers is to use them to implement your decisions, not as the source of those decisions. When a broker calls to recommend a stock, always ask yourself if their analysis is based on in-depth knowledge of the business or simply on the price chart, a rumor, or the need to generate commissions. If a broker calls to say, "Congratulations, you've doubled your money with that stock, but let's not get greedy, let's sell and move on to something else," consider that this call generates a commission on both transactions and that their profit is not aligned with yours. Company annual reports are perhaps the most valuable and underutilized source of information available to individual investors. They are public documents, freely accessible, that contain almost everything you need to know about a company. The chairman's letter at the beginning of the report is especially revealing. If it's vague, full of generalities, and avoids difficult issues, that says a lot about the quality of the management team. If it's specific, honest about the problems, and clear about the plans to solve them, it's a positive sign. The balance sheet in the annual report shows the company's financial strength, how much cash it has, how much debt it has, and how current assets compared to current liabilities. The income statement shows whether profits are growing and whether margins are holding steady or improving. The report's footnotes, which many people ignore because they are boring, often contain critical information about pending litigation, accounting changes, future spending commitments, and other factors that can significantly affect future results.
I also recommend reading the quarterly reports, which are shorter but provide updated information compared to the annual report. And if there's something you don't understand or that concerns you, call the company's investor relations department. In small and medium-sized companies, the CFO or even the president handles these calls. In large companies, there's a dedicated department. In any case, most reasonable questions can be answered if you take the time to ask. Visits to a company's stores, production plants, or facilities are also useful, though not always possible. When I can visit a store in a retail chain I'm considering investing in, I learn far more in an hour of direct observation than reading 3 analyst reports. Is the store clean and well organized? Do the employees seem motivated? Are customers leaving with full bags? Are there lines at the checkout? These observations don't replace financial analysis, but they complement it in a very valuable way. Technical analysis and charts. I've met many investors who dedicate an enormous amount of time to analyzing price charts, studying moving averages, support and resistance levels, candlestick patterns, and other tools of the so-called technical analysis. I have the utmost respect for their dedication, but I have my doubts as to whether that dedication is well spent. The premise of technical analysis is that past price movements contain information about future movements. I don't deny that in certain contexts and with certain tools, this may have some validity, but in my experience, a stock's price doesn't contain information whether the underlying business will do well or poorly. The price reflects what buyers and sellers think about the business today. What the business does tomorrow depends on factors that aren't shown on the chart. I've seen stocks that, according to all technical indicators, looked poised to rise, only to fall because their earnings were worse than expected. I've seen stocks that were technically oversold and continued to fall for months because the business was deteriorating. And I've seen stocks that were technically overbought but continued to rise for years because the company was still growing at extraordinary rates. What is useful of technical analysis is its role as a position management tool. Knowing support levels can help you set more favorable entry prices, and resistance levels can serve as benchmarks to assess whether you still see additional potential. But these uses are secondary to the fundamental analysis of the business.
The art of building and managing a portfolio. The ideal portfolio isn't the one with the best performance in any given month, but rather the one that generates the best results over several years with a manageable level of risk. Building it requires a balance between different categories and sectors, flexibility to add or reduce positions as circumstances change, and the discipline to resist market trends. My personal approach has always been to maintain a mix of companies from different categories. Stable companies provide a defensive base that withstands bear markets reasonably well. High-growth companies are the ones that generate the big returns over 3 to 10-year periods. Cyclical companies, well chosen at the right point in the cycle, can add extraordinary returns, and some turnaround or hidden asset companies complete the mix. I don't recommend dividing your portfolio equally among these categories. The right proportion depends on the market phase, available opportunities, and each investor's personal circumstances. What I do recommend is always having at least 1 or 2 high-growth companies in your portfolio, because they contribute the most to long-term performance. Regarding the size of individual positions, I would never concentrate more than 10 or 15% of my portfolio in a single company, no matter how convinced I am of its prospects. Negative surprises happen even with the best companies, and excessive concentration means that a single mistake can have devastating consequences. On the other hand, it also makes no sense to hold positions so small that even if you're right, the impact on the portfolio is negligible. If a company represents 2% of the portfolio and your stake increases tenfold, you'll have gained 20% on that position. If it represents 10%, the same trade will yield 100% of the portfolio's value. One tactic I've found useful is to start with small positions in promising companies and increase them as the fundamentals confirm the initial story. If I buy for the first time and subsequent quarterly results confirm the expected growth, I add more. If the results disappoint, I investigate whether it's a temporary or structural problem before deciding whether to hold, add, or sell.
I also recommend keeping a record of the reasons you bought each stock and reviewing that record periodically, not because you're going to follow it mechanically, but because it helps you maintain clarity about what led you to invest and what signs would indicate you were wrong. Without that record, it's easy to convince yourself that the reasons for holding a position are the same as they were at the beginning, when in reality, the situation is changed. Brokers, reports, and other sources of information. A broker can be a valuable ally or an expensive distraction, depending on how you use them. Good brokers execute your orders efficiently and can provide access to information that would otherwise be difficult to obtain. Bad brokers call you periodically to convince you to make trades that generate commissions for them, but not necessarily value for you. The golden rule with brokers is to use them to implement your decisions, not as the source of those decisions. When a broker calls to recommend a stock, always ask yourself if their analysis is based on in-depth knowledge of the business or simply on the price chart, a rumor, or the need to generate commissions. If a broker calls to say, "Congratulations, you've doubled your money with that stock, but let's not get greedy, let's sell and move on to something else," consider that this call generates a commission on both transactions and that their profit is not aligned with yours. Company annual reports are perhaps the most valuable and underutilized source of information available to individual investors. They are public documents, freely accessible, that contain almost everything you need to know about a company. The chairman's letter at the beginning of the report is especially revealing. If it's vague, full of generalities, and avoids difficult issues, that says a lot about the quality of the management team. If it's specific, honest about the problems, and clear about the plans to solve them, it's a positive sign. The balance sheet in the annual report shows the company's financial strength, how much cash it has, how much debt it has, and how current assets compared to current liabilities. The income statement shows whether profits are growing and whether margins are holding steady or improving. The report's footnotes, which many people ignore because they are boring, often contain critical information about pending litigation, accounting changes, future spending commitments, and other factors that can significantly affect future results. I also recommend reading the quarterly reports, which are shorter but provide updated information compared to the annual report. And if there's something you don't understand or that concerns you, call the company's investor relations department. In small and medium-sized companies, the CFO or even the president handles these calls. In large companies, there's a dedicated department. In any case, most reasonable questions can be answered if you take the time to ask. Visits to a company's stores, production plants, or facilities are also useful, though not always possible. When I can visit a store in a retail chain I'm considering investing in, I learn far more in an hour of direct observation than reading 3 analyst reports. Is the store clean and well organized? Do the employees seem motivated? Are customers leaving with full bags? Are there lines at the checkout? These observations don't replace financial analysis, but they complement it in a very valuable way. Technical analysis and charts. I've met many investors who dedicate an enormous amount of time to analyzing price charts, studying moving averages, support and resistance levels, candlestick patterns, and other tools of the so-called technical analysis. I have the utmost respect for their dedication, but I have my doubts as to whether that dedication is well spent. The premise of technical analysis is that past price movements contain information about future movements. I don't deny that in certain contexts and with certain tools, this may have some validity, but in my experience, a stock's price doesn't contain information whether the underlying business will do well or poorly. The price reflects what buyers and sellers think about the business today. What the business does tomorrow depends on factors that aren't shown on the chart. I've seen stocks that, according to all technical indicators, looked poised to rise, only to fall because their earnings were worse than expected. I've seen stocks that were technically oversold and continued to fall for months because the business was deteriorating. And I've seen stocks that were technically overbought but continued to rise for years because the company was still growing at extraordinary rates. What is useful of technical analysis is its role as a position management tool. Knowing support levels can help you set more favorable entry prices, and resistance levels can serve as benchmarks to assess whether you still see additional potential. but these uses are secondary to the fundamental analysis of the business.
17. Pay attention to insiders. If a company's executives and major shareholders are buying back their own shares with their own money, it's a very positive sign. If they're selling in large numbers, investigate why. 18. Spin-offs are frequently overlooked opportunities. When a large company separates a division and lists it independently, it's often an opportunity that institutional investors ignore in the first few months. 19. The long term works. Throughout history, investors who have bought good companies at reasonable prices and had the patience to wait have been rewarded. This historical consistency is the foundation of all stock market investing logic. 20. Enjoy the process. Investing is an intellectually stimulating activity that leads you to learn about industries, products, and businesses you would otherwise never have encountered. If you approach it with curiosity and rigor, it is one of the most enriching activities an ordinary person can undertake. Final letter from the author to the private investor. There's something I want to tell you directly, without beating around the bush, before you close this book. The stock market isn't designed to make you rich quick. If someone promises you that, they're either lying to you or deluding themselves. What the market can do, and has proven over decades, is help you build wealth gradually and sustainably if you have the discipline to follow some basic principles. These principles are not secret. I've explained them throughout this book, and you'll see them articulated in similar ways in other quality investment books. The difficulty lies not in understanding them. They are within reach of anyone with a basic education and a willingness to learn. The difficulty lies in following them when market emotions push in the opposite direction. When everyone is panicking and selling, principles tell you not to sell if the fundamentals haven't changed. When everyone is euphorically buying, principles tell you to be cautious if prices aren't justified by the fundamentals. Following those principles in such moments is incredibly difficult because it requires going against the prevailing opinion in your own emotions. But it is precisely this difficulty that creates opportunities. If everyone followed the correct principles, markets would be perfectly efficient and there would be no room for superior returns. The fact that most investors, both individual and professional, do not is what allows the disciplined and patient investor to outperform the market in the long run. You can be that investor. You don't need special talent or exceptional training. You need the principles we've discussed in this book, the discipline to follow them, and the patience to give them time to work. That's all it takes. Mr. Market will be there tomorrow offering irrational prices in both directions, as he always has. Your job is to take advantage of his excesses with the calm of someone who knows the value of their portfolio. Good luck, and may your investments always be one step ahead of Wall Street. The Fidelity Magellan, Lessons from a Legendary Fund. When I took over the Fidelity Magellan in 1977, it was a modest fund with $18 million under management and only a handful of institutional investors as clients. When I left in May 1990, it had $14 billion and over 1 million shareholders. It was the fastest growth trajectory in the history of mutual funds up to that time, and it generated an average annual return of 29% for 13 years. I recount this not as an exercise in vanity, but because I believe Magellan's story contains lessons that go beyond the numbers. The first is that the method works even on a massive scale. As the fund grew, the strategy of seeking well-managed companies at reasonable prices continued to produce results, although it became increasingly difficult to find opportunities in smaller companies because my purchases would move the market. The second lesson is that size is the enemy of performance in fund management. As Magellan grew, I needed increasingly larger positions to have any impact on the fund's performance. This forced me to focus on larger companies, which are precisely the ones other managers are also analyzing extensively. The advantage of investing in what no one else is following was inevitably diminished. Individual investors who manage their own money don't face this problem. They can invest in companies of any size, including the smallest ones that are systematically ignored by fund managers. This flexibility is a huge advantage that professional managers cannot replicate.
The third lesson is that patience was key to all my best investments. The stocks that generated the highest returns were, in most cases, positions I held for several years while the market took time to recognize the value I had identified. Impatience, the tendency to sell too soon when the price was rising or to buy at the wrong point in the cycle, was responsible for most of my mistakes.
The story behind some of my best investments. Let me share some of the investment stories that have most impacted me, not to boast about them, but because they illustrate better than any theory how the process works in practice. Stop & Shop was a New England supermarket chain I knew as a customer. I shopped there regularly and observed that the business was running smoothly. The stores were clean, the employees were helpful, the prices were competitive, and there were always customers. What I didn't know was that the company had a supermarket division on its balance sheet, trading separately at a price that practically paid for the entire Stop & Shop business on its own. In other words, the core supermarket business, which was profitable and growing, was practically free. This combination of a good business at a ridiculously low price is exactly what I'm looking for. The investment generated returns far exceeding what the market would have suggested at the time of purchase. Fannie Mae was one of my largest and most profitable investments. It was a government-sponsored mortgage lender that had faced enormous difficulties in the early 1980s when interest rates skyrocketed. Many investors had written it off. But when I thoroughly analyzed the business structure, I realized that the model was remarkably robust once interest rates returned to normal levels. The company had a lasting competitive advantage, access to cheap funding thanks to its government ties, and a dominant position in the American mortgage market. I bought a huge stake. In the following years, Fannie Mae became one of the largest profit generators in the American financial sector, and the stock price increased several times over. Ford Motor Company, during the first half of the 1980s, was another example of a salvageable company that the market had abandoned. Ford had accumulated enormous losses, its cars had a poor reputation for quality, and Japanese competition seemed unstoppable. But under the leadership of Don Peterson and Harold Pauling, the company had begun a radical transformation of its production processes, drawing inspiration from Japanese quality management techniques. The Taurus, launched in 1985, was an extraordinary success and demonstrated that Ford could compete on quality with any manufacturer in the world. When this began to show up in the numbers, I bought a significant stake. The stock multiplied several times over in the following years. Volvo was an investment I came to understand in the most curious ways. By calculating the value of Volvo's assets beyond its car business, I discovered that the company had investments in other companies, real estate, and other activities that added up to a value per share exceeding the price of Volvo's own stock. In other words, the perfectly reasonable car manufacturing business was essentially free. These kinds of situations are precisely what investors who are keen to uncover hidden assets look for. How to talk to the companies you invest in. One of the most powerful tools available to individual investors, and one of the least used, is simply to call the companies in which they invest or are thinking of investing. All publicly traded companies have an investor relations department. In large companies, it's a full-fledged department with several people dedicated to answering shareholder questions. In smaller companies, it might be the chief financial officer or even the company president. In any case, they're available to speak with individual investors if you call and introduce yourself as a shareholder or potential investor. What questions should you ask? The most useful ones are those you can't find answers to in the annual report or public documents. For example, what are the main factors that will determine the results for the next 12 months? How is the expansion into new markets, which you mentioned in the last report, progressing? Have you noticed any changes in customer behavior? How is the current situation in the sector affecting your plans? What you're looking for in these conversations isn't insider information, which would be illegal to obtain, but a deeper understanding of the business and the factors that drive it. You're also looking for an indication of the quality of the management team. Are they clear and direct, or do they dodge the tough questions? Do they have a coherent vision for the business, or do they change their tune depending on the market? Are they honest about the risks and challenges, or do they only talk about the good things?
These conversations will give you a perspective you won't find in any written analysis, and in many cases, they'll either confirm or challenge the investment story you'd constructed before calling. The individual investor in today's world. When I wrote the first edition of this book in 1989, the average investor had limited access to information. Annual reports arrived by mail, stock prices were found in the next day's newspaper, and speaking with a Wall Street analyst was virtually impossible. Today, the situation is radically different. Annual and quarterly reports are instantly available online. Stock prices are updated in real time on multiple free platforms. Analyst reports, once exclusive to large institutional investors, are accessible through multiple channels. Analytical tools that previously required expensive computer equipment are now available on anyone's mobile phone. All of this means that the informational advantage of individual investors over professionals has narrowed in the closely watched market segments. But in the less followed segments, especially small and medium enterprises, SMEs, the inefficiencies remain enormous. Wall Street analysts don't cover most small companies because they don't generate enough investment banking business. Large fund managers can't invest in them because their portfolios are too large. Individual investors still hold a structural advantage in this segment that no technological change will eliminate. The biggest threat to today's individual investor is not a lack of information, but an excess of noise. Social media, investment forums, YouTube channels, financial blogs, all of these generate a volume of opinions, predictions, and recommendations that would be impossible to fully process. The ability to filter out this noise, to identify genuinely useful information and discard the rest, is an increasingly valuable skill. My advice to today's investor is the same as it was in 1989. Spend less time looking at a screen and more time looking at the real world. You won't find the best businesses to invest in on a Reddit forum or on Twitter. You'll find them in your everyday experiences as a consumer, in conversations with friends and family about the products and services they use, and in the industries where you have professional experience. Technology has placed extraordinary tools in the hands of the individual investor. Use them to research and analyze, not to create more noise. Use them to access information that was previously difficult to obtain, not to follow the flow of opinions that will tell you what you want to hear. And remember that the most valuable analysis you can do is based on your first-hand knowledge of the world you live in.
10 observations on the character of the successful investor. Throughout my years managing Magellan and later as a private investor, I've had the opportunity to observe many investors, both professional and private, and to reflect on what distinguishes those who do well from those who do not. The first observation is that the best investors I've met are fundamentally curious people. They're interested in understanding how things work, how a business makes money, why a consumer prefers one product over another, how technological changes affect different sectors. This natural curiosity leads them to identify trends and opportunities long before most people. The second is that they have an unusual tolerance for ambiguity. In investing, you never have absolute certainty. You always invest with incomplete information about an uncertain future. Investors who can't tolerate that uncertainty tend to seek false signals of security, whether in broker advice, technical analysis, or market consensus. Those who accept ambiguity and work with it, building robust analyses on a foundation of imperfect information, generally make better decisions. The third observation is that they are skeptical by nature, but not cynical. They question market narratives, but are also open to changing their minds when new data emerges. The cynic who never invests because the system is rigged misses every opportunity. The gullible person who believes everything they're told loses money on every fad. The constructive skeptic, who questions but also acts when the fundamentals justify it, is the only one who achieves the best results. The fourth is patience, which I've mentioned several times but bears repeating. Successful investments rarely materialize in weeks. They usually require months or years for the market to recognize the value the investor identified. Those who lack the patience to wait for this process generally exit too soon and miss out on most of the profit.
The fifth is the ability to act independently. Group pressure is enormous in financial markets. When everyone is buying a sector, it seems unwise not to buy it. When everyone is panicking and selling, it seems irresponsible not to sell. The best investors have the confidence to act against the consensus when their analysis indicates it, without needing group validation. The sixth observation is that they keep track of their decisions and learn from their mistakes. They don't minimize them or quickly forget them, but rather study them to understand what went wrong and how to avoid the same mistake in the future. My own list of mistakes is long, and I review it periodically because it remains useful. The seventh is that they have realistic expectations. They don't expect to double their money every year. They know there will be bad years alongside good ones, and they don't get discouraged when the market doesn't cooperate. A return of 10 or 15% annually sustained over decades is an extraordinary result that few professional managers manage to surpass. Investors with these expectations can maintain their strategy through difficult periods. Those expecting impossible returns abandon it as soon as the first bad year arrives. The eighth is that they keep their emotions separate from their analysis. They don't become so enamored with their stocks that they can't see their flaws. They don't hate their losing positions to the point of selling them off at the worst possible time. They recognize when a position isn't working and can make rational decisions about it without letting pride or fear cloud their judgment. The ninth point is that they are disciplined with the process, not the results. They don't define their success by whether the market went up or down this week, but by whether they rigorously followed their analysis process. Short-term results contain too much random noise to be a reliable indicator of the quality of decisions. The process itself is. And the 10th and final observation is that they enjoy the process itself regardless of the results. Researching companies, understanding businesses, and identifying opportunities is an activity they find inherently interesting and satisfying. They don't need immediate market validation to stay motivated. This attitude is especially valuable during difficult times when results aren't forthcoming, but the process remains worthwhile. If you recognize yourself in most of these characteristics, you have the psychological foundation to be a successful investor. If some of them seem far removed from your current personality, don't be discouraged. Many of these qualities develop with practice and experience. A note on patience in time. I want to end with a reflection on the role of time in investing, because I believe it is the most underestimated factor of all. Time is an investor's most powerful ally. A company that grows at 15% annually for 20 years multiplies its profits by 16. An investment of 10,000 euros at that rate becomes 160,000 euros in 2 decades, simply by waiting. Compound interest, which Albert Einstein called the eighth wonder of the world, requires time to manifest its full power. But time is also the asset that most investors waste the most. They enter and exit the market trying to synchronize with its movements. They change their strategy every time a new trend seems more promising. They sell during panics when they should be buying. And the result is that even if they are physically present in the market for decades, in terms of effective time well spent, they may be there for far less time than they realize. The decision to invest a certain amount of capital in a portfolio of good companies at reasonable prices and leave it untouched for 10 or 20 years, periodically checking that the original stories still hold true, is one of the most profitable financial decisions there is. It's not glamorous, it doesn't generate interesting dinner party conversations, it doesn't produce the adrenaline rush of constantly buying and selling, but it works, and it has consistently proven this throughout history. The patient investor doesn't need to be right about the market this week or this month. They only need to be right about the quality of the businesses they invest in and the reasonable price at which they buy them. If those two things are well calibrated, time does the rest. That, after all, is the essence of investing one step ahead of Wall Street, not running faster than everyone else, but simply going in the right direction and not stopping.
Thank you so much, friend, for listening. Leave your ideas in the comments section so our community can grow by learning together. That's all for now. Until the next audiobook.